And I want to tell people that if you're at a young age and you're thinking that, oh, you don't have any value to add because you're new, the value that you have is you have time, you have flexibility, and if you're smart, you can actually help a real estate investor to find properties, analyze properties, manage properties, and then kind of expand from that.
Hey, Renter Retires, it's Adam Schrader here for another episode, joined as usual by the man, the myth, the legend, the founder and CEO of Rent to Retirement, Zach Lemaster. And we are pleased today to be joined by Eric Martel. He is the host of the Breakaway from the Rat Race podcast. But what you really want to do, how you really want to find him, is go on to YouTube, Instagram, TikTok, wherever you get your social media, and search for Eric Martel Official. You can also read his book, The Stop Trading Your Time for Money. You can read it all there, get it on Amazon, wherever else you get your books. But Eric, thanks for joining us today.
Well, my pleasure. Thank you for having me.
Yeah, well, it's a pleasure to have you here. We want to talk about something that we haven't touched on much on our show, and that's you really get into tokenization and NFTs and real estate. But first off, tell us a little bit about your journey in real estate. Kind of how did you get started? What was your kind of come to the realization moment where you said real estate is the way for me?
Yeah, so I mean, I had a few moments like that. So first of all, I came from like normal family. My parents were living paycheck to paycheck, but I really realized that there was a disconnect between their view of the world and how, the world was kind of working. And I was inspired at a very young age when I saw a guy that had like basically a food truck on a lot, and then eventually that food truck turned into a restaurant, and then it turned into a chain of restaurants and other businesses. And I knew that that there was something going on here, and then my parents were not they couldn't really explain that to me very well. So that's kind of eventually it took to university to find someone that was a real estate investor, and he was just a regular guy. He was just like a community college teacher, and he managed to have to build a 36-unit apartment building. He was building a shopping center. He was building assisted living facility, a nursing home, and I was just like, wow. And this guy is just no, shouldn't say it that way, but he's just a normal guy. He's just a teacher, and he's not teaching finance or anything like that. He was teaching like geography or history or something like that. So very interesting. And I felt that my parents and him were kind of like the same level in terms of finances, from the basic. But obviously he had an edge, a little bit more knowledge and smartness. And I wanted to grab into that, and he agreed to mentor me.
I love that so much. And I think that's the beautiful thing about real estate is that it can be treated as like a side business and a hustle. And then often if you're continually successful in it, it becomes more of a full-time hustle and a full business. But most people, I mean, there are college courses about real estate, but it's mainly about, selling real estate as an agent, right? This is not a traditional education path. This is
working for the big guy, the big boxes about, big skyscraper, and then you do analysis spreadsheet for the buyers or the developers,
right. And a lot of that I think isn't even applicable to most of the things we do as real estate investors. That's college in general, but I think that business school is probably more applicable, but this is a common path we've seen a lot of people go through is treating real estate, doing all these things on the side and just continually doing that, and actually like ultimately earning more capital and planning your retirement. I mean, this is the exact same path that we followed. So Eric, did you jump into real estate like right away? I mean, did you have other career paths, or how did you tell us a little bit more about that intro journey?
Well, so I was studying to be an actuary, and I did graduate as an actuarial student, actuarial math. And that's basically the math of financial risk. So typically the graduates work for consulting firm or life insurance company or pension plans, and that's kind of like the path. I worked in that field for a few years and stuff. But what the real trigger, the real important for me, the connection with that real estate investor is that with him I managed to buy my first 8-unit apartment building. So no money down, and and it was still cash flowing at the end. So basically ended up with a mortgage from a regular lender, a credit union, and then the rest was actually a vendor take back or a seller financed kind of note. And so 100% financing and then cash flowing. And then I knew that, I said, okay, well, this is it. I can make money now with no money. And I was just like, okay, right? How do we do that? And but I felt like I kind of, at that point, if I had to kind of send a message back in time to myself at that time, I would have said, don't go and get a job, like figuring out and work and network with the people. I was introduced to a lot of investors, real estate investors at that time. And I was looking at all the kind of stuff that they were doing, but I didn't see how I can add value. And I want to tell people that if you're at a young age and you're thinking that, oh, you don't have any value to add because you're new, the value that you have is you have time, you have flexibility, and if you're smart, you can actually help a real estate investor to find properties, analyze properties, manage properties, and then kind of expand from that. And that's kind of like where I missed the boat. And what I saw was a lack of money. So I said, well, I better get a job to get money and then invest. And then really that took me way off course for many years and tried different businesses, different things. And then only like 10 years ago, I came back to real estate after that.
Oh, that's interesting. I love that background. And to your point about how you add value, if you are a newer investor and you do have time, like you have hustle, right? Or you could have hustle. And I think people appreciate that all the time. We have people that reach out to us to say, hey, can we work for you? How can we add value? And, most of the time it's all talk and people, you give them a task or something in 30 to 90 days, they just lose steam or whatever. But, I pay attention to sometimes we'll give someone just a task. It's not even a value to us. It's just like, hey, are you going to do this? And you're going to come back with a response, right? And just kind of give people a little bit of a test. But same thing for me, with when I was learning under mentorships and stuff, like I would go above and beyond just to hustle, right? Like I would provide things to them that they didn't even ask for, and just keep putting stuff in front of them. And they're like almost to the point of, okay, I see that you're energetic, but let's give you some more direction because they couldn't ignore me. So I love that. So I want to pick your risk assessment brain just real quick. And we work, and Adam, don't let me forget. I also want to talk about since we're both in the turnkey space of how do you do market analysis, and where are you choosing to invest and why those locations, Eric. But from a risk assessment point, I just want to ask you. I'm curious in the market. I know you and I talked on your podcast about kind of the market right now. But from a risk standpoint, since you have a background in that as an actuary, how are you evaluating risk right now in today's market, and what should people be thinking about?
Yeah, so I think part of the problem is that people are trying to predict the market. They say, I think the interest rate is going to go down, so I'm going to wait, or the market, the real estate market is going to go down, so I'm going to do this and stuff like that. And trying to predict the market, predict the timing, and that doesn't work. You have to basically, instead of looking at one outcome and say, I'm going to go for that outcome, this is, you can have good reward if you're lucky, but you can also lose a lot of money if you do that. So what's important is kind of like, I don't want to call it like that portfolio diversification, but it is kind of like that. You want to kind of hedge your bet a little bit and say, okay, well, what happens if the interest rate go back up? So I buy a real estate rental right now, single family rental, and I'm at 7% interest. Well, what happens if the interest rate goes up? Well, nothing happens if the interest rate goes up. So I still, what if the interest rate goes down? Well, I can refi, I can do this, I can do that. What if the value of so you have to look at all these outcomes, and then you pick an investment or a couple of different investments that are going to minimize your risk and maximize your return at the same time. And real estate is really, it's a fantastic tool. And it's not really about the building. People are keep thinking about the house, the building, the rental. But as you and Zach, you know this too, is that when you build that portfolio, is your risk profile changes, and you kind of like, you're not looking at it as a house. These are financial instruments. They're cash flowing instrument. They bring money in. So do you think less of them as a house, as a real estate property, but more as a financial vehicle, a financial investment? And this is kind of where people need to think about. They think of it as houses, but it's really about finding that investment vehicle. And there's no investment vehicle like real estate.
Well, we could talk about that all day long, but I love this, and I want to actually dive in a little bit deeper here. What you're talking about is separating out the emotions from real estate and just looking at it analytically as an investment. So many people, when they're first starting out, which is a lot of the investors that we encounter, it's okay. It's natural to get associated emotionally with houses, especially, we associate houses that we would personally live in, right? But for a rental, you need to separate that out. But your risk assessment on a portfolio, that's so huge, because I always tell people, when you have your highest risk, when you have one rental, right? Like one single family rental, if that house, it becomes vacant, which will happen at some point in time, you need to plan for it, is that you lose 100% of your income from your rental portfolio. But if you have multiple doors, it balances out, right? If you have 10 properties in your portfolio, statistically speaking, probably a majority of those are going to be average. One or two are going to way outperform your projections, and then one or two are going to underperform. But it all balances out across your portfolio. And that's the important thing about building a portfolio, having diversification. But you do get lucky sometimes. I'll say this: sometimes you get properties that you need to, just sell and liquidate. But we were interviewing, I forget who it was the other day. I'll have to give them credit when we think of it. But they talked about the rental lottery, where basically, you buy a bunch of houses and you just don't know what the future is going to look like. But some of those are really going to take off dramatically. And people have seen that. People that have been investing for 10 or 20 years, you can have just, and it only takes a couple of properties to really take off, to dramatically increase your income. So the successful people that we interview, they invest consistently during all markets. You could associate this with dollar cost averaging in stocks, but it's just about consistency and making investments in all markets. Let me ask you one more actuarial question, because I love to pick people's brains when they talk about risk, and I love it to turn it around. And this is hard to quantify, but how would you explain, or how would you quantify the risk of inaction? Because to me, that's the bigger risk, is doing nothing and ending up old and decrepit and not having been able to live the life that I wanted to. Do you have anything to say on that?
Absolutely. I was biting my lip, just like, I hope you asked me that question, but this is exactly right. The fact that you're not investing in real estate and you keep your money in your sock drawer, that's an investment. The stock drawer, putting your currency in a stock drawer, that's an investment decision that you're making. And the investment decision that you're making is investing in US currency with an inflation so it's decreasing in purchasing power every year. So that's the investment that you're making. You agree that I'm going to lose 5, 6, 8% last year in inflation, on that money versus real estate investing. When you compare the two, so I did an exercise, and over 5 years, let's say you put you have $25,000 cash, you put in your sock drawer, and then today that $25,000, let's say, can buy you 5,000 cups of coffee at $5. 5 years from now, at 5% inflation, that cup of coffee is worth $6.50. Then 5 years from now, you take your $25,000 from your stock drawer and you want to buy coffee. Now you can only buy 3,400 cups of coffee. This is a significant decrease in purchasing power. And when you're staying on the sideline, when you're not investing your money, especially in high inflation environment, what happens is that you're going to lose that purchasing power. Even though every year you're going to look at your sock drawer, or maybe more than once a year, and then you're going to see, here's my $25,000. Here's my $25,000. But at the end, that $25,000 is worth less and less. And this is kind of like the hidden thing that people don't see and don't appreciate when they're looking at money. And in times of uncertainty, what happens, people want to herd their cash. They don't want to invest it because they are afraid that something's going to happen. But now they have the certainty that something will happen. They have the certainty that inflation will eat away at their purchasing power.
Yeah. And like you were talking about, Zach, with the rental lottery, I mean, if you owned rental properties before COVID, pretty much everybody hit the rental lottery whenever, COVID appreciation came around. So that's been good to see. But one question I had for you, Eric, is you mentioned when you got started that you had this 8-unit that you got into with no money down, and then you decided to go get a job. If you were able to put together a deal with no money down, why did you just think that you needed money for future investments?
Well, it took, first of all, to get that deal, it was not easy, right? So I had to scour the earth basically to find a deal. I had to find like I probably went analyzed like over 400 properties, and then I found like 2 or 3 that were kind of working, and then only one of them wanted to take seller financing. So I kind of felt that, okay, well, this is very painful. It took me many months to find that one deal. And then, then I thought, okay, well, if I had money, that'd be so much easier. Let me get a job, I get some money, and then I'll do that. And also the financing. I thought the financing would really, really help me to have a job. And in fact, it turned into a complete distraction, took me off track.
Wait a minute. Did you say that creative financing and finding seller finance deals takes work?
Yes.
Just a little bit.
I just like to compare sometimes with now. Look, we've been in the flipping business, and we've done. At one point I owned a property management company. At one point I managed all my properties, and so we've been in a lot of different facets of real estate.
Yeah.
And what I've just really found over time, and we've done creative finance deals. But it's just like, man, just being able to have income though too, and qualify for loans, and just put money down on properties and just do that over time, even though it seems extremely slow to like save up money for that next, like you get this compounding effect over time. And often that is just like sometimes the quickest way to just build a portfolio, because it's really about owning and owning over time in the market, right? And just letting real estate do what it does over time. But you got to own the properties first. And so I always look at, when I'm building out my portfolio, like what is the quickest path to ownership? You found a creative finance deal with no money down, but it took you 400 evaluations to do that. Yes. So, I mean, it's like, if you have capital and a good income source, great, keep that, put that money into real estate, rinse and repeat.
Yeah. Yeah, I agree. Yeah. I mean, so that's kind of the situation, and I was young too. So I thought, I was 18 years old, 19 years old. So, I thought, okay, this is great. Did this, done that, and then I didn't see that I could add value in that market, but I should have really connected with other investors. A lot of other investors were doing all kinds of very interesting things that I could have assisted and gain even more knowledge. But yeah, it didn't grab me at the time. I didn't see that I could add value. That's part of the problem.
And I know you're only 29 now, so do you still have that seller finance deal?
Oh, no. I got rid of it probably like 3 or 4 years after, and made a little bit of profit.
I love it.
Yeah.
So one of the things, and one of the, like I mentioned before, that we wanted to talk about was the NFTs, the tokenization. There's a lot of talk about that going on. I still don't really understand NFTs, especially because a lot of them seem to just be like a picture. And it's like, well, I can just download the picture and keep it on my computer. So can you talk a little bit about how real estate, I mean, one of the beautiful things about it is it's a real tangible asset that you can, rent out, you can sell, you can do whatever you want to do with. So talk about this new NFT tokenization market of real estate.
And it's not NFT, it's actually a security token that we're issuing. And the difference is really about kind of like, everything is tokens in this crypto world, but this one we call it a security token because it has real assets that are associated with it. And basically, Martel Invest is a company that invests in a single family rental portfolio. And then we basically broke down that company into small pieces, just like, a company with shares and stuff like that. So we broke down the membership of that entity into very tiny little pieces. And then we allowing people to buy a token for as little as $50. And that $50 basically gives them a piece of the company, a piece of the portfolio, a piece of the appreciation, a piece of the cash flow, just like they would when they invest in real estate themselves.
So you guys are doing this yourselves with your own company. I mean, what does this actually look like for the investor? Say they invest $50, $100, whatever, and they have essentially part ownership, right? This is really like a share of. So do they have? They probably don't have says in decision making, but how do they receive? How do they receive? Return on this, and what does that look like?
So, I mean, they get a Schedule K at the end of the year. They get a Schedule K in terms of the value of the business. Every month, we also distribute any kind of net cash flow that we might have. So that's the kind of thing that we're doing. And these net cash flow, everything gets into the digital wallet. So you can see in your digital wallet your share of Martel Invest or your tokens, how many tokens you have. And then you're also going to have in your digital wallet, this is where we're going to deposit also your net cash flow. And that's going to be given to you in USDC or USDT, which is basically stable coin that are pegged to the US dollars. So you can, it's 1-to-1 to the US dollars, and they're being very stable. Hence the name stable coin.
What is this is interesting because basically, I mean, it's a way, it's really about the business. It's not. Are there physical assets that are also composing this, or is it just based on the business income?
It's the business, but the business owns the properties. So when because you're owning a piece of the company, you're owning a piece of the real estate, and that's going to show up. So if there's any kind of capital gains because we're selling one of the properties or we're doing any kind of tax advantages, we want to do depreciation or bonus depreciation, that's also going to go into the Schedule K, and that could offset other taxable income that you have. So it's really kind of like being a member of a company, an LLC. You get all the advantages of that, except it's at a massive scale and broken down into very small pieces.
Okay. And this isn't really like a fixed or preferred return, like a syndication per se. This is you are a share owner or a shareholder. And so you basically the net cash flow, it's all based on company performance, right? On the portfolio performance. I would see that the advantages to someone that is interested in real estate, even though this is a little bit more separated, it would be, the ability to invest less capital than buying a house, right? Down payment, the being extremely passive. What are some of the,
cash flowing from day one. So, as soon as they buy into the property, there's some properties already, so they would get cash flow right away from the day they put their $50 in. There's also more liquidity. So we're working to put these tokens on an open exchange so that you would be able to, let's say you have 1,000 tokens, and then you say, you know what, I needed to pay this, I need $1,000. Then I can go in an open market and you can sell a few of the tokens that you own onto an open exchange. So it's a lot more liquid than the syndication, where your money is often stuck in there for 3 to 5 years. And if you want to get bought out, then it's a lengthy process to be bought out, and then kind of figuring out the value, when you're in the middle of a value add project on syndication and stuff like that, it's kind of difficult. Yeah. So we don't have to deal with all of that. For us, it's is that token, and you can go in an open exchange. So there's a probability or a possibility that the value of that token could be also higher on an open market. So you buy it at $50, but just like a stock on the stock market, maybe when you try to sell it next year, then the value of that token might be like $60, $75, could also be $40. But then that's the kind of thing, right? That you could have potentially an increase in value of the token just because it's a real business that's making real money that's backed by real estate. And you can't say that to about too many projects right now on the blockchain.
So that's interesting. Kind of just a summary. This is ability, and this is something, Adam, I don't think we've really explored with anyone we've interviewed yet. So this is somewhat of a new concept to us as well. But basically, the ability to invest in a company backed by real estate that's real estate centric, where probably maybe less risk profile than just say like a startup or something like this. Also, but it allows people to invest less, still having a tangible tie to real estate, but possibly higher risk, I would say, than, you're really investing in the company, so people need to do due diligence on you, right? And things like that. But the ability to invest less capital and more liquid. I think that's the biggest thing to me, is the ability to buy and sell, where, to your point, syndication, you could be tied up for one, it could take a lot more money and you can't invest $50 in syndication, so but it takes a lot of money to be tied up for a long time. And a lot of people don't realize when you go into syndication, yet you do not cash flow from day one. You have this value add period where, I'm in a syndication right now. We're on year 4 and we still don't have positive cash flow because it's taken so damn long to get the project stabilized. But anyways, just last question on this. What is the benefit? And this is more personal to me, but like, what's the benefit from the business perspective? What's the play with doing this? It's interesting, but how is it beneficial for the business?
Well, first, I think one of the big problems too is that, and it's kind of like single family rentals, selling those single family rentals to investors who want to build their passive income portfolio. What happened is that they just sometimes they didn't have the $25,000 or $30,000 they needed for the down payment, and then even if they did, they put their $25,000 and they get one house. So this kind of it's the risk profile. The tenant is not there. That's money that you don't have, that you're not getting. And so these are all kinds of problems that we're trying to solve for our investors when we're having discussions with them. And we thought, we have to figure something out. We have to be able to have everybody kind of invest, because I think there's most people think that, real estate is really a great investment. I want to invest, but I don't have $30,000. Now we're going to lower it down and say, well, you have $50, then you can start building. And you can have this snowball effect, starting with $50, but you're still going to have that snowball effect where you can go and invest. Every time you have another $50, you kind of put more money down. So that's the advantage. When you put that $50 in Martel Invest, your risk profile is very different. Now you're part of a portfolio of single family rentals. You have less money at risk and all of that. We also don't have any mortgages, so everything is no leverage, no mortgage. So that risk is gone also from that perspective. So everything is cash owned.
Interesting.
Yeah.
When you talk about it being a secure token, the securitization, does that mean actually like SEC came through and did a whole bunch of stuff with you? Talk a little bit about what that means as opposed to, because I don't think a lot of people know the difference between like a secure token and just a random token that gets put out there, because there's so many of those out there. Zach and I could make one tomorrow if we want, but it wouldn't be kind of what yours is. So talk a little bit about what that means.
So currently we filed a Reg D filing with the SEC. So where we are allowed to basically, get investment from accredited investors. But we're all in the process right now. We filed in December, for Reg A, where anybody would be able to invest their $50 in Martel Invest. So that's still being processed right now. We're expecting a response from the SEC in the next month or so, and see kind of how that. Obviously, they're going to have some questions. There's going to be some back and forth, but within the next few months, we should be Reg A approved. That means that anybody will be able to invest then in Martel Invest.
All right. Fantastic. I think it might be time to move on to the rapid fire. Zach, what do you think?
Oh, rapid fire. Well.
All right.
So for those of you who might have fallen asleep during the NFT or tokenization talk, let's spice it, because sometimes that stuff's like over me, man. I'm a simple guy, Eric. I just like bread and butter housing.
It's very simple.
Yeah,
I mean, imagine it's a share, but except that like right now, if I own a share of an LLC, right, of a company right now, a private company or a syndication, I can't do anything with that. That money is stuck in there. And if I want to get it out, if I want to do anything, I want to sell it for more than I paid for, and all that's very, very difficult. And I don't have anything tangible that's showing me that, hey, I have that, or I can, blah blah blah. So this with these token, it's kind of like, to me, I think is the way that real estate is gonna go. And I think I mean, you would be able to invest, instead of investing a bunch of money into an apartment building, you say, hey, I'm going to invest like $5,000 here, 500 here, 100 here, and then, have all this kind of like come together into one digital wallet, and you can see all your net cash flow coming in. I mean, that's perfect. You can sell, buy and sell, transfer, all kinds of stuff. To me, that's the future.
Very interesting to learn about different ways, and yeah, it's important to keep up on how just investing in general and money is changing, right? It's dynamic, and the crypto world and everything else. It's there's a lot going on, a lot of things changing right now. But let's get into rapid fire, Adam. I got a couple ones that we may not.
Now you made me have one more quick question before we get into it. What are y'all doing? Like apartments? Are you doing single families? Kind of what is in these tokens?
Well, just like Zach was saying, I mean, before you invest into these even security tokens or any companies, you want to have a company that has a solid track record. So our track record is on single family rentals. This is what we've been doing for the last 10 years. And then, this is why we're focusing on single family rentals. Even though we also did we probably did like 5 apartment buildings, but really the single family rental is core to our track record, to our experience and expertise, and that's why we're doing that for Martel Invest.
There's no question, that bread and butter housing, the single family residential, is the most stable asset class in an area that has high rental demand. Like talk about recession proof and stuff that's just consists like, that's about as safe and predictable as it gets, in my opinion.
Yeah, absolutely. To me, that's the best. It's even better than apartment building, and because. Yeah, this could be the subject of another show. But yeah, I mean, you know it very well. I'm sure you talk about that all the time. But yeah, to me, that's the safest asset class for sure right now.
And that's coming from an actuary, everyone. So there you go.
Exactly.
All right, so here we go. Where's the real estate market 1 year from now?
1 year from the real estate market, in terms of value, I would say it's going to be going up. But moderate pace, I would say.
Top three investment markets that have your attention right now.
So definitely the Midwest is still very solid for me in single family rentals. So that means like Cleveland, St. Louis, like anywhere in Ohio, really, Indianapolis, and I'm also investing in Detroit as well, Detroit area.
All right. What's your main criteria for properties? What do you look for in a property?
Basically, cash flowing. Imagine you have a property that pays for itself. I mean, just invest in cash flowing rental properties. That's the key element.
All right.
Where are interest rates going to be in 6 months?
It's going to go down.
There, Adam.
It's going to go down. It's been on the trend down since November. For the 30-year term fixed mortgage, except for January, I think it went up a little bit, but yeah, it's going to go down. There's also external things that are, I follow some economists and stuff like that, and they're looking at all kinds of weird stuff, and they're saying that basically they expect the interest rate to go down another 0.5 to 0.75% by the end of the year.
All right. So what's your favorite metric when you evaluate deals?
Basically, I would say return on equity, because that applies not only for the houses that you buy right now in terms of cash on cash return, but also looking at return on equity for properties that you already own. And then kind of, because people kind of forget that you own a home for even a rental for 10 years, there's equity built up there, and you can leverage that. And not leveraging it means that you're basically investing it at the appreciation rate of the property. And, it may not be that good. So return on equity is the short answer.
That's huge. And again, since it's rapid fire, I could talk all day on that aspect. You got to do it. You got to be using your equity. But what is one thing that, in your experience of investing over many years, what is one thing that you've seen consistently across people that have been successful in real estate? One trait.
I think it's been like disciplined and then basically taking action. I think that's been the key.
All right. What's your biggest win and loss in real estate deals?
Biggest win. I think probably a couple. So we bought like 5 apartment buildings, and we sold 4 of them in the last couple of years. And so these were the biggest win for us in terms of capital gains. So we enjoyed that quite a bit. Biggest loss is it's a single family house that we just finished the renovation, and it just burned down in Memphis.
Insurance claim, I would hope, in that case.
Yeah.
We don't have to go into that. What is your favorite tax advantage of owning long-term rentals?
Well, for me, I think it's the depreciation, bonus depreciation. That's very, very. I know we're kind of like running right. This year is going to be 80% for bonus depreciation, especially for single-family rentals, because then you can decide. You can look literally. I can look at my taxes for 2022, and I can go and say, okay, well, I need this much tax deduction. I'm going to do these 3 houses. I'm going to do a bonus depreciation on these 3 houses that I bought last year. And then I can basically, where else can you do this? I can do a cost seg now and then put it into for my 2022 taxes. It's amazing. You basically decide how much money you want to give the government.
And last one here, what should an investor be doing today to position themselves to be more successful 5 years from now?
So I think, investing in single family rentals, especially, but investing in real estate, cash flowing real estate, I think is very important. The cash flowing component is important because you want it to pay for itself. You don't want to have drain on your other resources. But anything that's cash flowing assets with leverage, is a great investment.
Eric, last one. What is your favorite song to play on guitar?
Favorite song? It's what is that called? With the Eagle, Hotel California. That's the one. I'm still working a lot. Now I'm trying to do more like Spanish style flamenco guitar.
Oh, there you go.
Very nice.
It's a tough. It looks so easy.
Adam can dance for you, the flamenco.
Yeah,
dancing,
that's
right?
the last thing people want.
It is so difficult. All
right. Well, Eric, thank you so much for joining us today. We really appreciate it. It's been great. Everybody, you can check out the Martel Invest token link down below in the show notes. We'll make sure that it gets you where you need to be. Again, Eric, really appreciate you taking the time to join us today to talk real estate. Everybody, don't forget, go on to whatever social media platform you use, whether that's TikTok, Instagram, YouTube, kind of you name it, and search for Eric Martel Official. That's Eric Martel Official. You can find all of his content there. And don't forget to head on over to renttoretirement.com to schedule a time to talk with us. You can also see what single-family cash flowing properties we have there. We're in many of the markets that Eric mentioned here today. And also don't forget to leave us a review on whatever podcast platform you use. If you leave us a review and send us a screenshot of it, we'll send you a $10 thank you gift card. And we'll enter you into a drawing that we're going to do at the end of June for a $500 closing cost credit. So that's at, go there, take a screenshot, send it to podcasts@renttoretirement.com. That's podcasts@renttoretirement.com. If you want to see more of our educational content, you can find that at youtube.com/renttoretirement. That's youtube.com/renttoretirement. Thanks so much for listening to today's episode, and we'll talk to you on the next one.
Thanks for watching the Rent to Retirement YouTube channel. Check out some of our other videos, like this one, or this one here.